it's taken a lot of strength to kind of coax investors into this market. And now that's happening at a time when we're starting to see a little breadth deterioration, starting to see some evidence that maybe the market wants to move sideways a little bit. Happy Thursday afternoon, everybody. Thursday afternoon means it's time for Townhall Takeaways. Willie Delwich here. Glad you tuned in. Glad you're listening. Townhall Takeaways is where we get together every week to kind of distill everything we've talked about in the market, we've looked at in the market, the various charts, the various tables, the various indicators, really try to distill a couple themes that we can kind of take with us as we go into the weekend and kind of chew as we're maybe away from the market a little bit, stepping away from our computer screens. A couple interesting things this week, some shorter term stuff, some longer term stuff, and a calendar pattern to, I think, pay attention to, or in this case, not pay attention to. So we'll start under this idea of mulligans. It's on the golf course, you hit a bad stroke, you don't like it, depending on who you're playing with, you get to drop your ball and where you were, hit another stroke, basically get a do-over. The market does not, however, allow mulligans. Doesn't matter if you're an investor, doesn't matter if you're the Fed, no mulligans allowed. And why do I bring that up right now? A couple of reasons. From the perspective of investors, we've seen a lot of time and energy spent talking about how persistent this pessimism was on the part of investors. 44 weeks in a row of individual investors, more bears and bulls on the AAI survey, really struggling to get above, sentiment from where it was in August of last year. So it's taken a lot of strength to kind of coax investors into this market. And now that's happening at a time when we're starting to see a little breadth deterioration, starting to see some evidence that maybe the market wants to move sideways a little bit. And so then the reaction on the part of investors will be interesting. They're in the market. They've moved into the market. How do they respond to the inevitable price volatility that the market brings? So far, what we're seeing is not terribly encouraging. If we look at it from the perspective of active investment managers, they've been the most excited about the rally. The NAIM exposure index soared not just to where it was in August, but got to where it was in April and March of last year. A little bit of price volatility. They moved ahead of the market, moved ahead of the price. Now that's starting to reverse. So a big drop in the exposure index this week. Similarly, individual investors, like I said, took a long time for them to turn bullish. They're bullish, more bulls than bears for 2 weeks. This week, it's back to more bears than bulls. Going forward, if we see kind of reluctant optimists think about it and have some buyer's remorse and say, nah, that's not for me, that makes rallies harder to sustain. At this point, I've said it before, I'll say it again, we need bulls to have a bull market. We're not at the point of excessive optimism. And so we want to see investors tilting towards equities, not tilting away from equities like we saw with the NAIM data this week, like we saw with the AAI data this week. The other one we look at closely is Investors Intelligence. That's released with that data comes out with a bit more of a lag. So we'll see going forward whether or not those advisory services have second thoughts as well. If they do, if we see that across the board, then the S&P 500 staying within this range that's been in since last summer, that becomes a little trickier. If we see the shift away from equities going forward, that's getting ahead of ourselves, but that's something to pay attention to. We want investors leaning into equities so we get an upside breakout accompanied by strong breadth. That's the basis of a strong bull market. Investors tilting away from stocks, the first sign of trouble, new lows, surpassing new highs. That's not the type of strength we want to see. So stay tuned there. Other area of the market would like a mulligan. I think the Fed would probably like a mulligan too. Not anything that they've done last year or even the year before, but I think going back to 2019, I think history is going to treat that as a policy mistake on the part of the Fed. Just from a data perspective, historically, we've not seen the Fed cut the Fed funds rate when the Fed funds rate has been significantly below the 5-year trend in nominal growth rate. That changed in 2019 when we were nowhere near being tight from a policy perspective, interest rates relative to growth, but the Fed cut rates at the time. Think about it. We had MMT being part of the conversation. We had deficits ballooning, outlays rising to their highest level in 7 years as a percent of GDP, $1 trillion deficits, labor market imbalances emerging, not after COVID, prior to COVID. We had central tendency measures of inflation, median CPI rising to their highest levels in a decade. The Fed was cutting rates, even though from a policy perspective did not make a lot of sense. I think that's unleashed a lot of the inflation issues, labor market imbalance issues that we have now. And that suggests to me they might not have a mulligan, but they need to make up for that mistake. And so as we think about where Fed funds rate's going, if we use this 5-year nominal GDP growth rate as a guide, that suggests 5.5%. The market's moved higher recently, but neither the Fed nor the market is up to 5.5% in terms of thinking about that as a terminal rate. And then one that stays there for a little bit. So I think that's where we're going. That's what history would suggest, is we got to get to or above that 5-year growth rate to say that the Fed tightening cycle has been completed. And then switching gears a little bit and thinking about things from a calendar perspective. We can't redo the calendar either, but typically if this were a kind of that normal 4-year cycle, we will have gone sideways in the midterm election year. At this point, we'd be going higher. Levels that we visited last year would be well into the rearview mirror if we were following that typical cycle. Instead, what we saw last year was lower over the course of the year. Yeah, the second half of last year was more sideways than lower, but that's, lower to sideways is not as robust as sideways to higher. And so in this case, my suggestion would be maybe the presidential cycle isn't the best guide going forward, in much the same way as leaning on some of the breadth thrust data that has been talked about might not be the best guide in this environment. I think we want to stay in harmony with the real-time indicators, whether they're price trend perspective. So think about long-term trends, the direction of the 200-day average for various indexes, or from a breadth perspective, think about new highs versus new lows. Things like that, not getting caught up on the what should have happened or what may have happened, but the what is happening in this environment, given that we've got investors that are a little bit nervous. We've got a Fed that's trying to make up for past mistakes. I think staying in harmony with the tape means staying in harmony with the trend that's actually taking place, not the one that we would like to see. So those are the takeaways this week. No mulligans for investors, no mulligans for the Fed, more tightening on the way, and a calendar that at this point we'd like to see it as a tailwind, but maybe it's best to kind of set it to the side and not be driving too much of our decisions at this point. Those are the takeaways. Thanks for joining. Thanks for listening. We do this every Thursday afternoon. Hopefully you'll tune in again next week. Thanks, everybody.